Let's begin with the biggest business story of the day, possibly the week, although the week is early yet. Medtronic, the medical device maker, is buying smaller rival Covidien for almost $43 billion in stock. The main reason here? Taxes, yes. By moving its headquarters to Ireland from Minneapolis, Medtronic says it could free almost $14 billion of cash now trapped overseas by U.S. tax policy on overseas profits. With us this morning, Bill George. He's the former CEO of Medtronic, who's now a professor of management at the Harvard Business School and one of the nation's foremost voices on matters of governance and management. Also, Bloomberg tax policy reporter Zach Miter is here. And Bill, if you don't mind, I'm going to begin with Zach because Zach is going to explain to us the difference between this deal, Zach, Medtronic and Covidien, and what sounds similar but I know is different, what we heard a few weeks ago from Pfizer and AstraZeneca.
That's right. A lot of companies that are inverting.
This is all about inversion.
Right, switching their corporate domicile to someplace outside of the U.S., like Ireland, are doing it to lower their tax rate. The U.S. Tax rate is 35%, the highest among developing countries. A lot of them want to get a lower rate through an inversion. Medtronic already has a pretty low rate, 18% about over the last 3 years or so. They've already been successfully lowering their rate by booking a lot of profits offshore and not recognizing U.S. taxes on them. They can't keep doing that forever because they can't access that money. This deal allows them to spend the money without paying taxes.
So unlike Pfizer AstraZeneca, which was a tax reduction approach, this is a free those overseas tax profits so we can spend that money.
It's reducing maybe a different amount of a different kind of taxes.
Okay. Bill, you were once the CEO of this company, Medtronic. You still follow it very closely. I know you remain a fan. Is this a good deal? Is this a good idea?
This is a great idea, but it's not about taxes. That's about the fifth or sixth thing down on Omar's list. Number one is expanding the mission to help more patients using technology to do this. And in merging with Covidien and acquiring these assets, they get number one positions in peripheral vascular, neurovascular, gastrointestinal, respiratory. First time ever for Medtronic getting into cancer, so it can use its technology. One of the reasons Covidien Eric came to Medtronic is because they lack the clinical capabilities to get these new ideas to market. Medtronic has great capabilities. So Medtronic's to expand its R&D as a result of this. But you're right. It had $14 billion trapped overseas, couldn't be used. It's already paid taxes on that, but at a lower tax rate because some of the things we started in the mid-90s, getting into Switzerland, to Ireland, before that into Puerto Rico. So Medtronic's always been active in tax policy, but it has this cash trapped. And so this frees up that cash. And the odd thing, a very unusual thing, is that Medtronic is now committed to spend an additional $10 billion over and above its strategic plans and Covidien's to invest in high-tech innovation in the United States, because that's where most of it's done. And the company wants to expand its innovation here in the United States. But to do that, it had to do the tax inversion, as you all have correctly pointed out, and there's no rate savings.
So, Bill, it sounds like there's all kinds of strategic reasons for Medtronic to do this deal, but here's my question for you. If it weren't done as an inversion, in other words, if Medtronic were to remain incorporated, domiciled in Minneapolis, where you are right now, would this deal make sense at this valuation?
It makes sense at this valuation, but to pay for it, you need to free up the cash, because that's what's paying for the cash.
But that means it doesn't make sense at this valuation because you can't free up the cash.
Yeah, no, the valuation's fair. I mean, it's a modest 29% valuation as valuations go. Medtronic's not looking to pay for it by cutting big cuts other than the Boston headquarters, which will consolidate into Minneapolis. So the governor of Minnesota, believe it or not, has endorsed this deal, which I found a very big, pleasant surprise. But yeah, it makes sense, but you can't get at the cash, so you have to free up the cash. If the president had allowed us to repatriate that cash, or allowed Medtronic to repatriate that, with, say, a tax holiday for reinvesting in the U.S. and R&D and capital facilities and expenditures and new ventures, then you wouldn't have this problem. But so far, for 5 years, nothing has been done in Washington.
Well, Bill, you raise a very big if, and it's a great way for me to bring in another one of our guests this morning, Greg Valliere. He's the chief political strategist with the Potomac Group in Washington. Greg, Bill just said if the president had allowed us to repatriate that cash, clearly Companies still have a lot of money trapped overseas. This is money that would cost them a lot more, at least in taxes, to bring back to America. Is this deal going to anger folks in Washington, motivate them perhaps to deal with this problem, or not?
Well, Democrats need issues, and this could fan more flames about companies outsourcing jobs. I'm sure Harry Reid will try to make a big deal of it. The problem is the two tax writers, a Democrat in the Senate, Wyden, a Republican in the House, Dave Camp, both are opposed to doing a standalone bill. They want comprehensive reform, and that's not imminent.
Okay, comprehensive tax reform is not imminent. We kind of know that.
Right.
And I'm not suggesting that you're not telling anybody anything they don't need to know. They do need to know that there has been no movement forward in Washington on comprehensive tax reform. But is it possible that yet another inversion deal, Pfizer AstraZeneca was very controversial, this one may prove controversial, will motivate people on both sides of the aisle to deal with the inversion problem and overseas tax profits in a discrete fashion?
Yeah, once again, a standalone bill, I think, is very unlikely. Now, Eric, if we got 2, 3, 4, 5 more big deals like this one, then I think the climate changes. But for right now, since the Pfizer deal fell apart, and this deal may be controversial, I just don't see anything this year.
Right. And you can see Walgreen being the next one. You know, they're under pressure from shareholders to re-domicile to Switzerland as part of their takeover of Alliance Boots. That's a company that everyone's heard of.
Yeah, Walgreen, there's no question. And in Europe, of course, they've heard of Alliance Boots. Sorry,
just a comment, Eric, if I may.
Yeah, sure, of course,
Greg's very thoughtful comment. He's got the political insight. I think he's absolutely right. But, you know, nothing's going to get done in this administration through 2017, because particularly after Cantor's defeat, is just going to split the sides. Comprehensive tax reform is a huge deal. And that, to me, could be years off. I think we got to get something done in this short term, because corporations have to find a way to manage their business. We want great global companies in the U.S. By the way, just point, Greg, this is to insource jobs. Medtronic's going to greatly expand the number of jobs in the U.S. over the next 5 to 10 years, as they've done with every other acquisition. So they plan to expand jobs, not outsource them. And this gives them the freedom to do that because they can invest more in the country. That's what we want to do. We want to build great global companies based in the U.S.
Bill, what's doable? If you say we need to do something right now, and yet Greg acknowledges that a one-off bill to deal with this problem, won't fly, how do we approach it?
Well, here's what's doable. A tax repatriation holiday for 6 months or 12 months that allows company to come back to the U.S. if and only if they present a plan to the Secretary of the Treasury to reinvest the funds over the next 5 years in the United States. So say a company presented a plan to bring back $8 billion, and they could justify they're going to invest it in added R&D, not the same R&D, additional plant and facilities, new ventures, investing in venture capital in the United States, but not in financial assets, but in tangible assets and things that are going to expand innovation in the U.S. I think that's very doable. The Republicans would get on board with that. The Democrats would get on board with it, but they need the endorsement of the president to have the courage to go out and get behind it and say this is good for the United States. I've been advocating that. I'm on record as advocating that as far back as 2010, but I've gotten a little discouraged. So companies are going to do what they have to do to create their long-term shareholder value by creating better value for their customers like Medtronic has.
That's right. And Medtronic, you could say that what Medtronic is doing is really just declaring a one-company tax repatriation holiday for themselves.
Yes.
I mean, they're saying we're going to spend the money in the U.S. We're bringing the money back without paying taxes on it, spending it in the U.S. That's what they were asking for from Congress.
Greg, is that A, a fair way to look at it, and B, I'm curious to know whether anybody, Republican or Democrat in Washington, is talking about an approach to this issue along the lines of what Bill outlined a moment ago?
Well, it's still a long shot, but there is one thing to watch, and that is they have to put funds into the Highway Trust Fund by August. And this would raise some money. This repatriation, at least in the first 2 years, would raise some money. There's been talk from the oddest of bedfellows, Harry Reid and Rand Paul. How's that for a pairing? Who have talked about maybe coming up with a deal. So it's not totally out of the question, but the odds are against it.
Now, Bill, in the meantime, should CEOs just continue to force the issue by exposing the folly, let's say, if we're going to take that side of U.S. tax policy and proposing these inversion deals, even if, in the case of Pfizer, AstraZeneca, they don't fly, or might fly, as in the case of Medtronic and Covidien, because this is an agreement. AstraZeneca was a reluctant partner. Covidien certainly is not.
Yeah. That's true, and that's very different when it's a friendly deal like this was, Eric. I think companies have to be looking at their long-term, building their shareholder value through great strategy, creating the technology in the United States, and selling it all over the world, as Apple has done, and building very strong companies here. I'm a big advocate of that. They have to do what they have to do, and within the law, and that's what Medtronic's doing, and that's what companies like Apple are doing. You can criticize them, but they're operating fully within the law. I think that's what we're called to do, and we have to serve our long-term shareholders. So I favor that. I do not favor, however, just going in and cutting back R&D or just shipping things overseas. I think this is a sound approach, and I think more companies may look at this and say, maybe we should do something like this, and eventually it could, I think it's a long shot like Greg does, could force some kind of action in Washington.
Well, until there is action, that option is on the table. Bill, great of you to join us. Bill George, he is the former CEO of Medtronic, now with the Harvard Business School. Bloomberg's tax policy reporter, Zach Miter, and of course, Greg Valliere, chief strategist at the Potomac Group in Washington.